Something absolutely insane just happened in the silver market. And I mean the kind of insane that has traders wiping their screens thinking their charts are broken. On Friday, January 30th, silver didn't just drop, it collapsed. We're talking about a 31% plunge in a single trading session, from over $120 an ounce down to the low 80s. This isn't a normal pullback. This is the worst single-day crash since March of 1980, back when the Hunt brothers tried to corner the entire silver market. But here's where it gets really interesting. While American traders are panic selling and watching their positions get liquidated, something completely different is happening on the other side of the world. In Shanghai, in Dubai, in Mumbai, physical silver is trading at massive premiums. We're talking $8 to $12 per ounce above the so-called spot price you see on your trading screens. So what's really going on here? Is this a genuine market correction, or is this something else entirely? Because when you dig into what actually triggered this crash, you'll find 3 specific events that all converged within 72 hours. And the timing? Well, let's just say it's raising a lot of eyebrows. Today, we're breaking down what I'm calling the silver triple threat. 3 separate catalysts that combine to create the most violent precious metals sell-off in modern history. We're going to look at the CME margin hikes that forced traders to liquidate billions in positions. We're going to examine the announcement that sent the US dollar soaring and precious metals tumbling. And we're going to talk about what's happening in Beijing and why it might be the most important piece of this entire puzzle. Because here's the thing that nobody's talking about on mainstream financial media. And while the paper price of silver, the price you see on futures exchanges, is crashing down, the physical metal, the actual bars and coins you can hold in your hand, they're becoming scarce and expensive. Really expensive. I've been tracking the precious metals markets for years, and I've never seen a disconnect this severe between what the paper market is doing and what the physical market is doing. And when you understand why that disconnect exists, you'll understand why this crash might actually be the setup for something much bigger. Let me give you some context. Just 3 weeks ago, silver was trading around $70 an ounce. By January 26th, it had exploded to $113. That's a 60% gain in less than a month. Then came Monday, January 27th, when it touched an all-time high of $122 per ounce. The metal had more than tripled in value over the past year. Solar panel manufacturers were scrambling for supply, electronics companies were paying premiums, and central banks, well, they were quietly accumulating while telling everyone else to stay calm. Then Friday happened. Within hours, silver lost over 30% of its value. Over $140 million in tokenized silver positions were liquidated on crypto exchanges alone. On traditional futures markets, the numbers were even higher. Traders who were leveraged 15 to 1, 20 to 1, they got wiped out instantly. Gold dropped too, don't get me wrong. It fell about 9% on the same day. But silver? Silver got absolutely destroyed. And that tells you something important about what's really happening in this market. The mainstream narrative is simple. They're saying this was profit-taking. They're saying the rally had gone too far, too fast. They're saying margin requirements increased because of volatility, and leveraged speculators got flushed out. End of story. But that narrative is missing some crucial pieces. Because while all of that is technically true, it doesn't explain why physical silver is still trading at historic premiums in Asian markets. It doesn't explain why refiners are reporting record backlogs for silver delivery. And it definitely doesn't explain the timing of these 3 specific events. So let's talk about what actually happened. Let's examine each piece of this puzzle, because when you put them all together, you start to see a very different picture than what's being painted on CNBC. We're going to start with the technical trigger, the CME margin hikes. Then we're going to look at the macro catalyst, the announcement that sent shockwaves through currency and commodity markets worldwide. And finally, we're going to discuss the elephant in the room that's been growing since January 1st, the situation developing in China that could fundamentally reshape the global silver market for years to come. This isn't just about a one-day price crash. This is about understanding the forces that are pulling the silver market in 2 completely different directions. And if you're holding silver, thinking about buying silver, or just trying to understand what's happening in the broader commodity markets right now, you need to hear this. Let's dive in. Let's start with the technical trigger that started this whole cascade, the CME margin hikes. Now, if you don't trade futures, let me explain what margins are in the simplest way possible. When you trade a futures contract, you don't pay the full price up front. You put down a deposit called margin. If silver is trading at $100 an ounce and each contract represents 5,000 ounces, you're not putting down $500,000. You might only need to put down $15,000, depending on the margin requirement. That's leverage. It amplifies your gains when you're right, and it absolutely destroys you when you're wrong. The CME Group, which runs the COMEX silver futures market, they adjust these margin requirements based on volatility. More volatility means higher margins. It's supposed to be a risk management tool to protect the clearinghouse from defaults. But here's what happened in January. The CME didn't just raise margins once, they raised them multiple times in rapid succession. On January 7th, they hiked silver margins from 9% to 11%. That's a 22% increase in the amount of capital traders need to hold their positions. Then, just 3 weeks later, on January 28th, they announced another increase. Margins were going up to 12% for standard risk profiles, and even higher for accounts deemed high risk. And then, as prices were already falling on Friday, they announced yet another hike. This time, margins were going up by 33% for gold and 36% for silver, effective Monday, February 2nd. Think about what that means. If you're a trader holding a leveraged position and suddenly you need to post 36% more collateral, you have two choices. You either deposit more money into your account immediately, or you sell your position. And guess what most traders did when they got those margin calls? They sold. This created what's called a liquidation cascade. As prices start falling, more traders hit their margin requirements. They're forced to sell, which pushes prices lower, which triggers more margin calls, which forces more selling. It feeds on itself. And we saw this play out in real time. On the hyperliquid exchange, which offers tokenized silver futures, over $71 million in precious metals positions were liquidated in a single day. Silver alone accounted for the majority of that. One whale, a large trader, had an $18 million position completely wiped out in a single liquidation event. Across all platforms, including traditional futures exchanges and crypto venues, we're looking at well over $140 million in forced liquidations just in silver. When you add gold and other metals, the number goes even higher. Now, here's where people start asking questions. The CME says they raise margins in response to volatility, but critics point out that raising margins during a sell-off actually makes the volatility worse. It forces more selling at exactly the wrong time. Some analysts are calling this a calculated move. They argue that when silver was rallying to $120, when retail traders were piling in and everyone was getting excited, that would have been the time to raise margins to cool things down. Instead, the big hikes came after the selling had already started. The timing has led to accusations that these margin hikes aren't just about risk management. There's a theory that they're designed to protect large institutional players who might be caught on the wrong side of the trade. If major banks are short silver, meaning they bet on prices falling, and prices are instead exploding higher, those banks are in serious trouble. A margin hike that triggers mass liquidations and crashes the price would bail them out. Now, I'm not here to tell you that's definitely what happened. I can't prove that. But what I can tell you is this has happened before. In 2011, when silver hit nearly $50 an ounce, the CME raised margins 5 times in 8 days. Silver crashed by 30% shortly after. Same playbook. The pattern is hard to ignore. Silver rallies hard, margin requirements get hiked, leveraged positions get liquidated, price crashes, rinse and repeat. But here's the key question. If this was just about managing volatility, why are physical silver premiums still so high? If demand had genuinely collapsed, you'd expect physical dealers to be offering discounts to move inventory. Instead, they're charging massive premiums and running out of stock. That disconnect tells us that the futures market and the physical market are operating in two different realities right now. The futures market is driven by leverage, speculation, and yes, margin requirements. The physical market is driven by actual supply and actual demand. And speaking of actual demand, we need to talk about what's happening outside of the paper trading world. Because while the CME was engineering this technical flush, there was a much bigger macroeconomic event unfolding. That brings us to catalyst number 2. So we've covered the technical trigger, the margin hikes that forced leveraged traders to liquidate. But that alone doesn't explain the magnitude of Friday's crash. For that, we need to look at what happened in the macro environment. On Friday morning, news broke that reshaped expectations about the future of monetary policy. The announcement of Kevin Warsh as the nominee for the next chair of the Federal Reserve. Now, why does this matter for silver? Because precious metals, especially silver and gold, they move inversely to the strength of the US dollar. When the dollar goes up, metals typically go down. When expectations shift toward tighter monetary policy, toward higher interest rates, toward a stronger dollar, precious metals usually suffer. And Kevin Warsh, he's viewed by markets as a hawk, someone who prioritizes fighting inflation over supporting economic growth, someone who's more likely to keep interest rates higher for longer. The moment that nomination hit the wires, the dollar surged. The DXY, which measures the dollar against a basket of other currencies, jumped significantly. And commodities, particularly precious metals, got hammered. Gold dropped 9%, silver fell over 30%. The market was essentially repricing its expectations about dollar strength and monetary policy in real time. But let's add some important context here. In the months leading up to this crash, gold and silver had been rallying on fears of dollar weakness. There were concerns about massive government debt, about potential dollar debasement, about countries moving away from the dollar as a reserve currency. Central banks around the world had been buying gold at record levels. Silver was riding that same wave, but with even more momentum because of its industrial demand story. The green energy transition, solar panels, electric vehicles, semiconductors, all of these sectors need silver, and they need a lot of it. So you had this perfect storm of factors pushing silver higher. Safe haven demand, industrial demand, supply deficits, and concerns about currency debasement. The metal had gone from around $30 just a year earlier to over $120 at its peak. That's a more than 300% gain. And whenever you see moves like that, you have to ask yourself, how much of this is fundamentals and how much is speculation? According to multiple market analysts, including former strategists from major banks, the silver market had become disconnected from reality. One analyst called it broken. Another said the volatility was unheard of, and that prices were being driven more by wild liquidity flows than by actual supply and demand fundamentals. When you have that kind of speculative excess in a market, all you need is a catalyst to pop the bubble. And the Warsh nomination was that catalyst. But here's what I find fascinating. The sell-off wasn't uniform across all markets. In the United States, on the COMEX, prices crashed. But in Asia, in physical markets, silver was still commanding massive premiums. In Dubai, physical silver coins were trading at nearly $100 per ounce, while the paper spot price had crashed to the low 80s. In Shanghai, the premium over the London spot price was running $8 to $12 per ounce. These aren't small premiums, these are massive disconnects. What this tells us is that while speculative money was fleeing the futures markets, actual buyers of physical silver, the manufacturers, the industrial users, they weren't seeing this as a fundamental collapse in value. They were seeing it as a temporary dislocation in the paper market. And that brings us to a really important distinction. There are two silver markets operating right now. There's the paper market, where contracts are traded, where leverage is king, and where prices can swing wildly based on technical factors and sentiment shifts. And there's the physical market, where actual metal changes hands, where supply is limited, and where industrial demand is real. The paper market is massive. Some estimates suggest there are over 350 paper claims for every physical ounce of silver backing those claims. That's not to say those claims are fraudulent, but it does mean that the paper market is disconnected from physical reality in terms of scale. When you understand that disconnect, Friday's crash starts to make more sense. The paper market got flushed, leveraged speculators got wiped out, but the underlying physical supply and demand dynamics, those didn't change overnight. Which brings us to the third and perhaps most important piece of this puzzle. While the U.S. futures market was melting down, and while the dollar was strengthening on hawkish monetary policy expectations, something else was happening in China. Something that started on January 1st and that could fundamentally reshape the global silver market. Let's talk about the export controls. On January 1st, 2026, China implemented new export licensing requirements for silver. And this isn't just regulatory paperwork. This fundamentally changes how silver flows around the world. Let me give you the numbers to understand why this matters. China is the world's second largest silver producer. They refine somewhere between 50 to 70% of the world's silver supply. And their industrial sector consumes over 50% of global silver demand, mainly for solar panels, electronics, and semiconductors. So when China says we're restricting silver exports, that's not a minor policy change. That's a major shift in global supply dynamics. Now, the media keeps calling this a ban, but that's not quite accurate. It's not a total ban. What China did was implement a licensing system. Only 44 approved companies can now export silver from China, and they have to meet strict criteria. They need to have produced at least 80 tons of silver in the previous year. They need specific environmental certifications. They need proven export track records. Smaller refiners and exporters are effectively shut out of the international market. This creates a bottleneck. It reduces the amount of Chinese silver that can reach global markets. Why would China do this? Well, their official explanation is resource conservation and environmental protection. But if you look at the broader context, there's clearly a strategic element. China is in the middle of a massive green energy transition. They're building solar panels at an unprecedented scale. They're dominating the electric vehicle market. They're pushing hard into advanced semiconductors and artificial intelligence. All of these industries are silver intensive. By restricting exports, China ensures that domestic supply stays in China to feed their own industrial machine. It's the same playbook they used with rare earth elements. Control the supply, secure it for domestic use, and create leverage in global trade negotiations. The timing of these controls is particularly interesting. They were announced back in October, set to take effect January 1st. So the market had months to prepare. And what did we see in the weeks leading up to January 1st? Record silver exports from China, over 660 tons in October alone. Companies were front-running the restrictions, getting as much silver out as possible before the controls kicked in. But once January 1st hit, that flow stopped. And the impact on global markets has been significant. Here's where it gets really interesting. And while the paper price of silver was crashing on U.S. exchanges, physical silver in China was trading at massive premiums to the rest of the world. The Shanghai Gold Exchange, where actual physical silver is traded, was showing prices $8 to $12 per ounce above the London spot price. Think about that. In New York, leveraged traders are panic selling. In Shanghai, buyers are paying premiums to get physical metal. That's not normal market behavior. That's market bifurcation. We're seeing the emergence of two distinct price regimes. There's the Western paper price, driven by futures contracts, leverage, and speculation. And there's the Eastern physical price, driven by actual industrial demand and supply constraints. Some analysts are calling this the great divorce between paper silver and physical silver, and China's export controls are accelerating that divorce. There are reports of Chinese companies and Indian buyers approaching silver miners, offering prices $10 to $15 above the market spot price for immediate physical delivery, not for futures contracts, for actual metal. Why would they do that? Because in their world, where they need silver for manufacturing, where they can't just print more supply, the actual metal is worth more than what the paper market is saying. Meanwhile, inventories at the COMEX and the London bullion market are draining. The COMEX reported silver inventories around 135 million ounces, down significantly from previous levels. And deliverable inventory, the amount actually available for immediate delivery against futures contracts, is even lower. This creates a really interesting dynamic. The futures market can push the price around in the short term through leverage and liquidations. But if physical demand remains strong and supply is constrained by Chinese export controls, eventually the paper market has to reconcile with physical reality. And that reconciliation could go one of two ways. Either physical demand collapses because the price is too high, which doesn't seem to be happening based on the premiums we're seeing, or the paper price has to rise to reflect actual physical market conditions. Now, some people are calling China's move a form of economic warfare. They're saying it's designed to hurt Western industries that depend on silver while benefiting Chinese manufacturers who get preferential access to domestic supply. And there's probably some truth to that. But regardless of the motivation, the effect is clear. The global silver market is fragmenting. And that fragmentation is going to have consequences for prices, for supply chains, and for anyone trying to navigate this market. So where does that leave us?